Hewlett-Packard Inc., dividend growth stock, dividend yield 3.62%. Should you buy Hewlett-Packard Inc. or Hewlett-Packard Enterprise, 3.63% dividend income? Which of the two is the better investment? Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, a.k.a. Mr. Valuation. And once again, I'm going to do an Analyze Out Loud video here, looking at the Hewlett-Packard companies, I like to call them. It's Hewlett-Packard Inc. and Hewlett-Packard Enterprises. And I want to talk about these two companies from the standpoint of dividend income, dividend growth, and potential total return. In other words, are these a value investor's dream? And I think both of these represent high-quality value stocks in the dividend growth sector that you can look at. Now, it's up to you to decide, but I also want to point out some nuances, and I want to add in here how to utilize the FastGraphs Fundamentals Analyzer software tool to help you make investment decisions so that you get the best out of using the tool and you get information that enables you to make learned and hopefully profitable, but even more important, prudent long-term investment decisions. It's all about investing for the long term. So let's start out by looking at HPE Inc. This was the original predecessor company, and it kept the Hewlett-Packard symbol, the original Hewlett-Packard symbol, and it kept the historical stock price and so on. But I want you to notice, I'm going to click here down into the split and spinoff tab that's in the bar down here, and notice that in 2015, they actually spun off the Hewlett-Packard Enterprises. We'll talk about that in a moment. But Hewlett-Packard is headquartered in Palo Alto, California, and it develops personal computers, PCs, printers, and related supplies, as well as 3D printing solutions. So it's really like a hardware company. But what's really important that I want you to see here is that after it spun off the Hewlett-Packard Enterprises, and I'm going to focus on that time frame now, notice that the growth rate of the company accelerated dramatically to over 21% a year. It's had some really good years. It really unlocked a lot of shareholder value from that perspective. The company yields a 3.62% current dividend yield and has an earnings yield of about 14.59%, which is typically double what I like. But there are some very interesting factors here. I want you to notice, and I talked about this in my last video about the blue line. The orange line represents PE ratio equal to growth rate. So the orange line on this graph is a PE of 21.1, utilizing the 9-year time frame or post-spinoff time frame. So the company generated a lot of significant growth here. And remember, I've always said that by buying a stock at fair value, it allows you to participate fully in the growth of the company. So just a rough calculation here, not perfectly precise. If you'd have bought this stock at a PE of around 10, which was its normal PE since the spinoff, and held it to a 10 PE, you got about a 26.9% return, which includes dividend income. Now, that's very consistent with the 21% growth, as well as the dividend income that, as you can see by my mouse here scrolling at the bottom, has actually increased each and every year, since the spinoff, since they spun off the Hewlett-Packard Enterprises. Now, I want to talk about this company as a dividend growth stock, so there are things that are very important. Number one is operating cash flow. This is a cash flow machine, and you can see that the cash flows have also grown at about 13.4%, and the company is trading at a nice historical normal price to cash flow of about 6.44, which is slightly under the historical normal price to cash flow of 7.16. So that indicates that it's fairly valued based on cash flow. But what I really want you to note here is, if I even take price and the normal PE off, is the cash flows of, $1.87 a share covering 50 cents in dividends. Recent cash flows, $5.25 covering 78 cents in dividends. In other words, this company has a lot of cash flow available to cover their dividend income. And then I always talk about the acid test, which is free cash flow. And I want you to notice, since the spinoff, the company also has generated prodigious free cash flow growth of about 24.75%. But be careful with these kind of numbers. I want you to learn to use this tool. Okay, so what I want you to note is that was a 173% surge in free cash flow in October 2016 from October 2015, which was, post the spinoff, which they spun off in November of 2015. If I ratchet this back a couple of years, I want you to notice that the cash flow fell dramatically. Now remember, this is pre-spinoff, so this is both companies combined here. And then the cash flow began growing again and grew prodigiously. But I would shorten this by 1 year because the normal cash flow growth has been closer to 13%. And I think that's a more appropriate number. Now, the normal price to earnings ratio is that the market has been discounting this. It has not been giving it, a valuation, even on free cash flow, that was equal to the company's, growth rate. It's only been trading at about 8 times free cash flow, 8.51. So now if I put weekly closing stock price into the equation, I can see that gives me a very strong valuation reference. Now, once again, I always like to point out, this is an analyzer tool. You can visually analyze. You've got a great back test here automatically built into the tool that allows you to look and see how the market has valued this stock, how the company has performed as a cash flow generating business, free cash flow in this case, and then how the market has valued those free cash flow generation. And obviously you want to buy the stock when it is at a discount to the free cash flow multiple that would historically be commanded. And right now it's trading at that free cash flow level. So it's not cheap maybe by any standards relative to recent historical norms post-spinoff, but it's fairly valued at this level. So, and the cash flow is clearly covering the dividend. So I think that's a, very, very important aspect of it here. All right, so, looking at these major tests, we've got a 3.62% dividend current yield. We've got a free cash flow yield of 12.09%. And again, very, very attractive numbers for a value investor to look at. So let's move on now and let's look at Hewlett-Packard Enterprise. Now, Hewlett-Packard Enterprise was part of that original spinoff in 2015. You can see the company started in November of 2015 after it was spun off from the previous company I was showing. And then they had a couple of spin-offs as well in 2017 and again in 2017. One was to computer sciences and the other was, I think, DXT Technologies. I'd have to look that up. But the point is they also had some spin-offs, but they've got pretty decent growth in adjusted operating earnings here as well. They suffered a little bit during COVID, and, it's to be expected. Most companies did. But the point I want to get at is this company has been very, very healthy as an independent operating company. As far as what Hewlett-Packard Enterprise does, after being spin off from Hewlett-Packard, it focuses primarily on networking, storage, containerization, and other software and consulting businesses. So it's a different animal than Hewlett-Packard. But note that its dividend yield is 3.63%, and its earnings yield is 15.08. Once again, we see a company that is cheap. Now, going through the same process, I look at operating cash flows. Once again, we see operating cash flows, but now keep in mind there were some spin-offs here, and that'll come into play here in a moment. The normal price to operating cash flow of 6.77 is trading at 3.91. So we've got a better margin of safety here with operating cash flow. Now, from a free cash flow perspective, because of these spin-offs, we didn't have great free cash flow there, but post those spin-offs, the company has been generating free cash flow for the last couple of years that, is greatly protecting the dividend. So I think the dividend is very, very safe here. Here we've got a BBB rated investment grade company with some really healthy financials. And looking at the Hewlett-Packard or HP Inc., the printer company, we also have a BBB rated company. All right, so both of these companies are very, very strong. Now we can, quickly go into the financials and go into things like the fund graphs. And I do want you to see some interesting aspects here. And I want to kind of feature how to utilize the fund graphs also to help you make better decisions when you're making these investment decisions. So what I want to do here is I want to start by looking at the balance sheet. Let's go into balance sheet and let's look at the amount of cash that HP has on board. Okay, and I want to do that in millions so that we get, a better idea. They've got about $4.3 billion in cash. Now their cash has decreased in recent years. But if I want to look at, long-term debt, for example, I can look at long-term debt, and I want you to see that they have almost enough cash to simply on hand to pay off their long-term debt. Now, from a standpoint of cash flow, going back to cash flow a minute, if I look at net operating cash flow, you can see their net operating cash flow is also very, very strong, and they could easily, amortize all their debt very, very quickly just from their operating cash flow. And then once again, if I look at free cash flow, you can see that free cash flow also would allow them to pretty much amortize their debt. And you can see that when I look at just the last few years. So HPQ, Hewlett-Packard, the printer company, looks very, very attractive. Now, if I go into the same, test and go into the financials and then go into fund graphs for Hewlett-Packard Enterprise, and once again go into in millions and look at look at the balance sheet and look at the total cash and short-term investments, I see this company has about $4.3 billion in cash. If I look at long-term debt, the company has about $10.8 billion in debt, but they have, they can pay off almost half of their debt with their current cash on hand. If I look at the company from the standpoint of net operating cash flow, you can see that, net operating cash flow currently represents, more than half of what their long-term debt is. So they could reduce their debt and pay it off. I don't feel that debt is really an issue with either one of these companies. So the reality is, let's go back and look at these companies both from a different point of view. Now, let's look at it from, before I leave this, I do want to look at one more aspect. I want to go and look at share buybacks, because this is a very shareholder-friendly company, and both of these companies are. But we're looking at HPQ here, and I want to go into the income statement and look at diluted and basic shares outstanding. And I want you to notice that the company has been buying back shares aggressively, so that's been, very favorable to the shareholders, because I'm focusing on the income potential of both of these stocks at this point. Now, if I go into Hewlett-Packard Enterprises and go through the same process here, let me get rid of what I've got on there already. Let me go into the income statement and look at basic and diluted shares outstanding for Hewlett-Packard Enterprise. Once again, I see that the company has been buying back their share. And of course, you can see that their dividend has been growing as well, and they've been, easily covering the dividend with cash flow per share and so on. So now let's go back into the historical graphs for these companies, and let's go into operating earnings, which is what I'd like to look at, operating earnings. So here we're looking at Hewlett-Packard Enterprise, and let me get back to Hewlett-Packard, the original company here. And again, I only want to look at it post the spinoff, because that's where the company is really important. So what I want you to see is I want you to see performance first of all. And if I just look at performance since the spinoff, the company produced more dividends than the S&P 500, and it produced a higher growth rate than the S&P 500 by about 1 percentage point annualized, and it produced a higher total return. And by the way, the dividend growth has been, average growth has been 18%. It's a little more, and the compound growth has been 16.8, almost 17%. So now again, you've got an anomalous year here, so I'm going to take that off. And I think a 9 or 10% number is more realistic for this company. But here's what I really want to point out here. I want to go back to this valuation. The company was technically trading at around 14 or 15 times earnings, which is what I want you to notice the company had normally traded at or higher prior to spinning off. It was only post the spin-off where the company started becoming so cheap. But if I bought it, as I showed you already, at fair value and held it to where it was at fair value, measuring performance without simultaneously measuring valuation, I get this marvelous 26.9% number, which simply is saying I was participating fully in the growth rate. Now, even though the company is currently undervalued, in my opinion, trading at a low discount to valuation, I still would have made almost 20%. That's the power of growth of earnings, and that's the power of value investing. Buying the stock when it was theoretically, based on this new paradigm of valuation here that we're seeing, buying it when it was trading overvalued at around 16 times earnings, the rate of return still was 14.8%. But that's with some PE ratio contraction built in. We still had a very great investment. Now, going into Hewlett-Packard Enterprises to finish this kind of logic up, if I go into Hewlett-Packard Enterprise, once again, I have these valuation anomalies that I want you to be very careful of. So if I shorten this time frame and I buy the stock at fair value, here it had about a 6.5 or 7% growth rate. If I hold it to fair value, I get that rate of return that's consistent with how fast the company grew. Now, looking at performance gross here, I see it dramatically underperforming the market. But the point is, we're seeing it drastically underperforming because we start out with a PE of 10 and end up with a PE of 6.6, or, not, we'll call it a 40-some% discount. The PE has shrunk that much. So you want to always pay attention to valuation. Now, looking forward on the forecasting graph, the analysts, and there are 21, 19, and 19 analysts forecasting the future at a 15 multiple, which I believe would theoretically make sense for this company. The rates of return, annualized rates of return, would be staggering for this company. However, recognizing the fact that it's only traded at about a 9 or 10 multiple in recent years, and once again, we can see that it's been trading at 8, 9, or 10 times earnings. If I go all the way max, it's been trading at about 10 times earnings. That's the blue line on the graph. So if I'm forecasting using that more conservative number, and here I'm using the 9.1 number, I still have very attractive annualized rates of return if this company simply went from a 6 multiple up to a 9 multiple. If it went up to the 15 multiple, and I can only go to 13.65 here, you can see that the annualized rates of return are extraordinary, and that's all the while getting a 3.63% dividend income, if you will, while you wait. This is HPE. Going back to HPQ and looking at both companies, I've got a very similar, at a 9 multiple. If this company simply went back from a blended P of 6.8 back up to a 9 multiple, I'd get 19 or 20% rates of return. If it went to that 15 multiple that I think it probably ought to deserve, I get these 45 or 50% annualized rates of return. Personally, for me, I kind of like HPQ better because of the cash flow consistency and so on. But I have to also give HPE a pass because of the spinoff activity they did, and it caused some CapEx distortions and so on. But the bottom line is I think both companies offer you equivalent yields. Both companies offer you the opportunity to see dividend growth, and both companies offer the opportunity to see total capital appreciation. Now remember, the short term, it's anybody's bet and anybody's guess. I never make short-term calls on this channel. I'm always thinking long-term, and I'm looking at the long-term growth rate of what the company would be, and then what, looking at various, scenarios of what I could make on the company, assuming it could grow. Ben Graham talked about using historical growth, and he talked about using the last 5 years historical growth, which I don't think is necessarily realistic for this company's. But I do want to point out some other things. I want to look at Morningstar. Morningstar gives it a 3-year, this is HPQ, gives it a 3-star rating, but they call it a 5-star price, about 17. The stock's trading at 26, has a fair value of 29. I give it a little higher valuation than that. As far as Hewlett-Packard Enterprise, HPE, they also give it a 3-star rating. They say the fair value is around 14, and the stock trades at 13. So everybody thinks basically the stock is inexpensive. I like both of these companies better apparently than Morningstar does. So my point is, in this given market, you can buy at very, very low valuations, and I think the risk here is in the valuation. I think the risk is already baked in, if you will, in the current low stock price. So both of these companies, I think, are worthy of your consideration. I don't know if we've hit bottom yet, but I think both of these stocks could be bought if you were willing to hold them for the long run today, and you'd do very, very well in the long-term future. They're both good companies with good cash flow generation, and, for dividend incomes, growth stocks, cash flow is king. Anyway, this has been Chuck Carnevale saying thanks for watching. If you enjoyed this video, give me a like, ring the bell, subscribe to the channel if you haven't, and for goodness sake, get a subscription to FastGraphs. If you own stocks, the value that this product, this research tool brings you is just really incredible. You can do so many things with FastGraphs. You can see how the business has performed historically, what's expected of it in the future. You can dig deep into the financials. There's so many things you can do for it for a very small, cost. So take a look at FastGraph if you haven't already. We do offer a 7-day free trial. Give it a look and see if it helps you. There's over 19,000 companies in the database. And by the end of this year, we'll be adding, or at the end of this year, we hope to be adding international stocks. That's actually under development already. We also got a lot of enhancements coming down the pike that our developers are currently working on. So those of you who are subscribers, keep your eye open for that. Anyway, this has been Chuck Carnevale saying thanks for watching. We'll talk to you again real soon.